Hello, fellow Rebel Capitals. Hope you're well. So I want to do a quick live stream here on Saturday because we've got big news in the banking system. I'm sure a lot of you have heard we had another bank go bust, and you're going to get a kick out of the name. Josh, I know we did a video on this bank probably 2 months ago because I remember making fun of the name of the bank back then. And now, sure enough, they haven't gone full retard, but they've gone full bust. Maybe that's the same thing. They only got about halfway there when we did that last video. So let's shoot over. Let me do a screen share. And we're going to go over to the Wall Street Journal. I've got some highlights here. The name is not First Republic Bank, but Republic First. I'm not making this up. This proves that we're living in a simulation along with everything else that happens in our daily lives as of the last 3 or 4 years. So First Republic, Silicon Valley Bank, Signature, they all went bust March, oddly enough, 1 year ago, 2023. And now all of a sudden, Republic First, the inverse of its cousin, First Republic, just went bust. Smaller bank, but the real important details on this story are hiding beneath the surface. So let's go down, check it out. Republic First faced some of the same problems of the 3 regional banks that failed last year. Paper losses on bonds that lost value as interest rates rose and high proportions of uninsured deposits that can quickly flee. And we've gone over this over and over and over, so I'm not going to address the back end mechanics as to why, like Silicon Valley Bank went bust, but they pretty much summed it up right there. So bottom line, they're having the same problems. The first questions that came to my mind is, okay, so if they were facing the exact same problems the banks faced 1 year ago, not 1 day ago, not 1 week ago, but 1 year ago. And like I said, I know they've been in the news for the last, or on and off for the last couple months, having problems, because Josh and I did a story on this bank because I remember making fun of the name. So they've had a year to figure out these problems. Question number 1, why didn't they hedge? Why? They've had a year, for heaven's sakes. Why wouldn't that be the very first thing they did if the only problem here with the banking system is simply the fact they have some 10-year treasuries that went up in yield? And I'm just using 10-year treasuries as a proxy for, the long end of the curve. That makes absolutely no sense. Oh, but wait, there is more. I actually wrote some notes for this one. How about the discount window? Remember that? Remember Fed is pushing everyone to the discount window. As long as you got some decent collateral, you can go ahead and post it there, and we'll give you all the liquidity you need. Remember, we, the Federal Reserve, are the lender of last resort. So why didn't they go to the discount window? And if they didn't, what does that tell you about the discount window itself as far as being a bailout? If you want to look at it, it might be a bailout in the eyes of the Federal Reserve, but the banks, for whatever reason, see it as something that is totally off limits. In fact, just by using it, it's a self-fulfilling prophecy, right? So whenever the Federal Reserve comes out, the point here is whenever the Federal Reserve comes out and says, oh, don't worry about this, don't worry about that, or you hear the talking heads on CNBC saying, oh, worry about the banking system, whatever. Yeah, okay, fear monger. You don't realize that Jerome Powell has a tool for that. It's called the discount window. Duh. We see how effective it was. And the third thing, and probably the most shocking item when I read this story, is the fact that the BTFP just expired March 11th. So it wasn't that long ago. So if they've had the exact same problems of all these other banks that went bust 1 year ago, A, why didn't they hedge? B, why didn't they use the discount window? And if you say because they didn't get 100 cents on the dollar through the discount window, then why the hell didn't they go to the BTFP? Let's remember, just because it closed March 11th doesn't mean that you had to immediately pay the money back. No, there's a year grace period. So this Republic First Bank could have gone to the BTFP March 10th and said, hey, Fed, here's all this garbage collateral or treasuries, let's just say that we have to take a 70% haircut if we go ahead and sell them into the market to get the liquidity we need because we have all this deposit flight, but you're going to give us 100 cents on the dollar. Why didn't they do that? This makes no sense at all. Let's keep going. Well, I guess that's all I liked about that article. Let's go on to the next one. The Financial Times. Oh, I'm sorry. What I wanted to, the next thing I just remembered. The next thing I wanted to point out was this article, and most of the mainstream media is saying, oh, nothing to worry about here. Oh, yes, another banking failure, but this doesn't have anything to do with the economy because we all know the economy is on fire. The economy is booming. The economy is actually too hot right now. I mean, you can tell how hot the economy is just by how many banks are failing. Oh, they just don't want you to say, oh, look, bank failure? No. I think that's Elvis over there. Yep, that you got to see this. Sweep it under the rug. That's what's going on right here. But I wanted to point out that the mainstream media is saying that this is a big nothing burger. Don't listen to those people on the alternative media. Don't listen to that George Gammon guy on YouTube, because Fulton Financial Bank, or Fulton Financial, has come in and purchased all of the assets and the liabilities of Republic First. So there is absolutely nothing to worry about. Okay, well, now let's go over and think about another bank that has been in the news recently that has gotten themselves into big trouble. In fact, they were on the brink of going bust, and they still are, to the point where this Steve Mnuchin guy has to come in with all of his political connections to try to save what is left. So what was the big problem with New York Community? Oh, that's right. They bought all of the assets and liabilities of Signature Bank. Just like Fulton Financial is buying all of the assets and liabilities of this garbage Republic First Bank. I always get a kick out of this. It's like the balance sheet was totally toxic for this bank, to the point where they couldn't even use the discount window, to the point where they couldn't even hedge, to the point where they somehow couldn't even have been bailed out by the BTFP. But yet, magically, if this horrific balance sheet goes over to and is absorbed by another one, it just magically becomes pristine. Like, how does that one work? So my point is, we've got to put Fulton Financial on the good old watch list here. And I would be very surprised if they don't run into the same problems that New York Community Bank has been running into lately. But there are a couple more points of this Financial Times article that I wanted to discuss. The number one, and by the way, this was the Wall Street Journal, was from yesterday. This article was from March 7th, just to be clear, so a few weeks old here. The number of problem banks in the U.S. has jumped 18%, regulators warned, as New York Community Bank was stabilized by a $1 billion capital raise by former Treasury Secretary Steve Mnuchin. I have no proof of this, but just using some common sense, we've got New York Community Bank. So my assumption is there's a lot of these politicians, these Wall Street types that probably have accounts there, and they have connections with Mnuchin, and so he's just bailing out his buddies. I think just providing liquidity for them to transfer their assets, the bank's liabilities, somewhere else. And why didn't they do that with Republic First? Because it's in Philadelphia. And none of the Wall Street guys that have yachts that are parked about 100 feet away from my Airbnb have accounts with Republic First. They have all their accounts with New York Community Bank. And honestly, the more time I spend here in St. Bart's, and the more of these Wall Street types, hedge fund managers, investment bankers, yada, 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 that I spend time with, you realize how a lot of what happens in U.S. politics and in financial markets is a factor of who you know, not really what you know. But let's get back to the article. FDIC on Thursday said the number of weak U.S. banks has risen by 8 to 52 in the final 3 months of 2023. And keep in mind, this was a few weeks ago. So now I would assume it's risen by a lot more than that. They said that in and of itself was the biggest jump since the demise of Silicon Valley Bank. Delinquencies in credit card and commercial real estate loans were on the rise. And we're now at the highest level in almost a decade. Let me repeat. Delinquencies in credit card and commercial real estate loans were on the rise, the FDIC said. And we're now at the highest levels in almost a decade. Yet the economy is on fire. And by the way, how do we have sustained levels of consumer price inflation if everyone is defaulting on their debt payments to the bank? Like, those two really don't jive. More on that in just a moment. NYCB, New York Community Bank, a mid-sized U.S. lender with more than $100 billion in assets. And I highlighted this next line for a reason, which was not on the FDIC naughty list. I want to point that out. New York Community Bank, when they started experiencing all these problems, was not on the FDIC watch list, the naughty list, the bust list, whatever you want to call it. And by the way, nor was Silicon Valley Bank, First Republic, or Signature when they went bust. And in fact, Credit Suisse, if my memory serves me well, had just passed one of these stupid stress tests by Basel III or whatever the regulatory group was, like weeks prior to them waving the white flag. So let's keep going down the article and you'll see why I'm emphasizing that so much. Oh, and here we go. Hudson Bay Capital, Reverence Capital Partners, and hedge fund Citadel are co-investing in the deal which closes money. This is basically bailing out New York Community Bank. And if you don't remember Citadel, let's go back to GameStop. Remember GameStop and what happened? If you saw that movie, Citadel, Ken Griffin, he's the big player there, kind of the ultimate financial insider that's moving around all these kind of chess pieces. He's the go-to guy for the bailout. But as we know with GameStop, I can assure you one thing, he ain't going to be losing money. Or he's just scratching the back of some of his buddies, bailing them out for future favors that will be due whenever he runs into any problem or needs a little bit of, a little bit of wink, wink, nod, nod help. And here we go, the mainstream media coming in and saying, well, yeah, there's these problems in the banking, but nothing to see here, nothing to see here. Just turn on CNBC and listen to how well the economy is doing. The FDIC does not name the individual banks on the problem bank list. Oh, that's the naughty list. It's called the problem bank list. But the data indicated that the banks on the list were either small or mid-sized lenders. So don't worry about this, guys. Don't listen to George Gammon or anyone else on the alternative media space. If he's telling you there's some problems beneath the surface, it's just because he's fear-mongering, because he's trying to get clicks and views. That's what I always get accused of. But I want to point out, the reason they're saying don't worry is because the banks that are on the naughty list are very small and they're not systemically important. But was New York Community Bank on the naughty list? No. Was Signature? Was Silicon Valley? No. Was Credit Suisse? No. So the fact that the only banks on the naughty list are small banks really should give no one any assurance whatsoever when all these banks that blow up aren't even on the list to begin with. In fact, that's probably a contrarian indicator. Geez. Now let's think about this through the lens of the hot topic, the topic du jour. You see my French? I'm working on it here. The topic du jour, which is inflation and rapidly declining nominal GDP growth, real GDP growth. So let's first and foremost go to bank credit. And I've been pounding the table on this for quite some time. But we go back to August of 2022, and it's pretty much flat. That is not good. What this tells you is what we, in fact, just in seeing this, I'm looking at March of 2023 when it declined even further. But the spidey senses should have been on high alert right here when you see this uptrend, which is typical, but then you see this flattening out, just like we did right here, but they didn't have all the bailouts. The spidey senses should have been tingling right here with the banking system. This is telling you something is wrong underneath the surface. Something is really, really wrong. If the banks aren't increasing lending on net balance, that's because the perceived counterparty risk is skyrocketing. Remember, this has nothing to do with liquidity. This has nothing to do with bank reserves. This has nothing to do with the regulatory stuff or any of that. This simply has to do with banks seeing more and more risk. Therefore, they tighten lending standards, while at the same time, demand for loans is decreasing because the economy is not going up, but it's becoming more and more shaky. So what we see, going back to this FT article, is even if the banks that we have to worry about are just small and mid-size, it doesn't really matter for overall lending, because we have a bank go bust every 3 months, let's say. The big banks look at that and say, okay, counterparty risk, higher, not lower. And if counterparty risk is higher, I'm pulling back the reins. And why is bank credit so important? Because this is the main driver of the money supply. We look at M1, and that's, by the way, the 1970s. We discussed that in a video the other day. And because when people compare the 1970s to today from a standpoint of inflation, they conveniently leave this out, that the money supply was increasing massively back then. And although the money supply increased in 2020 and 2021 more recently, it's gone down. And again, as you guys know from watching my videos, you got to completely ignore this jump up right here, because that was just a change in the way that they measured M1. So let's look at M2, and you see the exact same thing. So the bottom line is what we know from seeing this further, or these further problems materialize within the banking system, is that perceived counterparty risk within the monetary system as a whole, not just inside the United States, but likely outside of the United States, is increasing, which would lead you to the conclusion there's a higher probability that bank credit continues to flatline, if not decline. Very surprising if it goes up substantially under these conditions. And if it doesn't go up, then there's very low probability that the money supply aggregates go up to the point which would lead to sustained consumer price inflation. You can get bumps and kind of supply shocks, or you can get just bursts of inflation. And to be clear, it's not like the inflation comes back down or the prices come back down to the level they were before. That is not what I'm saying. They continue to increase, but they just increase at lower levels. And at a certain point, if you have enough banks go bust, like we saw in 2008, 2009, a financial crisis, then you could actually see a short burst of actual price deflation, like we saw in Q3 of 2009. But when I look at what's happening with the banking system, for me, that leaves me with a base case that is inflation will likely, or this most recent uptick in inflation will most likely be temporary. That's really the bottom line here, because I just don't see how it's sustained with all of the problems that they have in the banking system, when they are the ones that are responsible for creating the currency units that would lead to the higher prices, leading to higher and higher prices. When you're looking at like the wage price spiral, or the price of oil going up, leading to the price of other goods going up at the same rate and continue going up, because oil's input for pretty much every single thing that we buy. That, to have sustained inflation, we need the 1970s, which is money supply going like this. And to have that, we need the banks lending. That's kind of my main focus with everything that's happening right now with, what was it? Republic First, or was it First Republic? Well, I'm sure there'll be many more to come. And like we've been saying on this channel for quite some time, unfortunately, we're probably still just in inning 5 or 6 of this banking crisis. I've been saying that for the last year. And unfortunately, on that one, I've been right. All right, guys, enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. Got to check out Rebel Capitalists Live. I mean, this is like 3 or 4 weeks away. We're going to have some incredible speakers there. You can check them out. And we're going to be discussing all of these topics at length. That's for sure. You don't want to miss this one. You can look at the speakers, past speakers, topics, and some of the VIP guests, like my good buddy Robert Kiyosaki, at rebelcapitalistlive.com. We'll see you in the next video.